Hi, everyone. Thanks for being here today. We have a great webinar set up for you today on tax and the crypto exchange. We have a presentation from our friends at KPMG and Refinitiv who are going to take us through some of the context related to possible coming IRS guidance and a little bit of the history there related to crypto information reporting. My name is Ashlyn Keeley. I am a reporter and assistant editor at The Block, and I do a lot of reporting related to tax. So I was invited to be here today and hopefully ask some incisive questions related to the presentation we have here. I figured we should start with some introductions. Nelson, can we start with you? I think you're on mute.
Sorry, Ashlyn. Thanks everyone for coming, especially during this lunch hour for a tax talk. My name is Nelson Sood. I'm the tax compliance officer at Refinitiv. I work with some of the folks who manage the products on the tax reporting side at the firm, including crypto tax reporting, and I also monitor some of the tax regulatory developments in this field.
Phil,
Thank you. And welcome everybody. My name is Phil Garlett. I'm the managing director at KPMG, specializing in information reporting and withholding issues with a particular focus on cryptocurrency. And Cameron, I'll turn it over to you.
Hi, I'm Cameron Ruth. I head up tax solutions for Refinitiv. I've been in the cost basis reporting and tax reporting arena for over 20 years now.
Awesome. So we have a chat function and a questions function also set up. So feel free to drop any sort of questions or thoughts that you have there. I'll try and sort of guide a conversation and pick out any interesting questions there in addition to my own. But with that, let's take it away and start with our presentation here.
Oh, perfect. Thanks, Ashlyn. We've done our introduction. So in terms of the topics that we have for today, we have three. Basically, one, we wanted to talk a little bit about something that's been in the headlines over the last few months, which is the IRS enforcement efforts to get information out of crypto exchanges for tax information. A bit of what those John Doe summonses are and sort of what the implications are for the industry going forward. But our focus principally will be on third-party information reporting. Phil and I and Cam are all sort of in the weeds in terms of dealing with Form 1099 reporting for financial institutions. So we'll give you a little bit of our experience with 1099s and what that might mean when it comes to this particularly new frontier for crypto. And then finally, what does all this mean for a financial institution or an exchange or custodian dealing with customers and the IRS? Are the interests of customers and IRS somewhat similar, or are they a bit more diametrically opposed? I think that's sort of part of what we want to discuss for today. Phil or Cam, do you want to add anything in terms of our overall topic?
No, that's excellent, Nelson.
So Phil, we've moved on to our first topic, which is IRS John Doe summonses. And I'll just begin. I don't want to spend too long on these, but I think over the last few months, some of you might have seen the headlines that the IRS has applied for a court order, at least in a couple of cases, to get tax information from crypto exchanges, one of which was out in California with Kraken Exchange, and another was closer to home, at least for me, near the Boston area with Circle Financial. And I don't know, Phil, do you want to say give a little bit background of what John Doe summonses are, just for those who might not know?
Yes, sure, Nelson, happy to do that. So generally, when the IRS wants information from somebody other than the taxpayer, they issue a summons. That is an administrative order to produce information to the IRS, and the summons will specify the information. In general, when the IRS is asking for specific information, it doesn't need to get, when I say specific information, I mean specific to a taxpayer. It doesn't need to get a court order. If the third party refuses to comply with the summons, however, the only enforcement mechanism for the IRS is to ask a court to enforce the summons. So that's the way it works when you have a specific taxpayer. A John Doe summons, as it sounds like, is a summons that the IRS issues to a third party, such as a crypto exchange or a bank or a broker. And it doesn't ask for specific information related to a specific client. What it does is it asks for information related to a class of financial institution clients, and the class is specified in the summons. Before John Doe summons can be issued, however, the IRS does need to get approval. The reason for that is Congress didn't want the IRS just going on fishing expeditions to get information willy-nilly, if you will, and then trying to figure out who might not be reporting their income accurately. So, as Nelson said, several financial institutions have received John Doe summonses. So far, generally, the courts have been willing to enforce those John Doe summonses. I think in the Kraken case, and correct me if I'm wrong here, Nelson, a district court did ask the IRS to refine its summons a little bit, so it didn't refuse to enforce it, but it asked the IRS to refine it. And Nelson, I'll turn it over to you for any comments you want to add.
Yeah, I think that's my understanding as well. There was a court order basically for the IRS to better explain why they were asking for the different pieces of information. But essentially, as Phil said, the John Doe summonses is a summons to the particular institution to provide tax information on their customers. It's not that the institution did anything wrong. It's more, as Phil said, that they're investigating what they think to be a group of people who potentially could have avoided taxes due to their crypto transactions. And so that's the nature of these John Doe summonses. So instead of saying, well, I think Phil's neighbor, Irene, is avoiding taxes, and therefore I'm going to the exchange to get information records for Irene. The IRS is saying, I think there's a group of people here who have been not filing their tax returns for crypto trading, and therefore we want the whole group of people get information so that we can determine which of the taxpayers might be in non-compliance.
Yeah, and at the risk of plugging my own work, I did write about the sort of court debacle initially related to the Kraken case. So yeah, the court had asked the IRS to sufficiently tailor its request, and about a month later, they did win court approval for that summons.
That's right. And I think what we wanted to to highlight with these summonses, there's probably three things, and we might go to the next slide too. One is that the IRS is getting increasingly serious about tax enforcement. But the second, as we get into the next slide, is that the information that they get from these John Doe summonses can be quite messy. So the next slide talks about a group of information that they're looking for, which is basically identity information. How do we, who is this particular account holder? And they're asking for date of birth, name, maybe if they have a tax ID, physical address, phone numbers, email address, and email address and phone number seems to be the big items that they're looking for at this stage, because they think a lot of people who sign up on crypto exchanges, sign up basically with a telephone number and the email address. But with that information, they try to identify who the account holder is with cross-checking with their own tax records. But it's a messy process. You have the identity information, and then they're asking for a lot of records that help them identify these particular account holders. And then they get to the actual transactions, which is what they're really interested in. So Phil, do you have some thoughts on that? It's sort of this, the use of the John Doe summonses and maybe whether it's effective or not as we sort of segue into talking about tax regulations.
Sure, Nelson. So is it effective? Ultimately, yes. The IRS gets enough information to know who's trading crypto, and they can cross-check their tax returns to determine if those crypto transactions being reported. Is it an efficient process? Most definitely, I think the answer is no. And the reason I say that is, first of all, from the exchange's point of view, the crypto exchange, it is a highly labor-intensive process because the exchange needs to go in its records for each customer who's covered by the John Doe summons, produce all the information, including, I think we'll get to the specific transaction information, organize it, and present it to the IRS. Then the IRS gets a whole bunch of information, not in a standard format, although the John Doe summons will request specific classes of information. It's not produced in a form that can readily be inserted into IRS systems. So it's messy for the IRS. From a taxpayer point of view, it's messy in the sense that, in two senses really. One, the taxpayer probably has no idea, unless the exchange or bank or broker has notified the taxpayer that the IRS has this information. The second reason it's messy for the taxpayer is because the IRS is getting information, but it doesn't necessarily get information that tells it how the taxes or how the tax liability should be calculated. They can figure it out probably, but it doesn't, the John Doe summons doesn't produce information that says, Bob had taxable income of $10,000 from crypto transactions. What it does is it says, Well, Bob had 250 crypto transactions totaling $100,000. Maybe the IRS knows the basis for each transaction, but probably not. And so, they know that there were 250 transactions for $100,000. That looks fairly sizable, but the income tax liability at the end of the day is only $10,000. And the way the IRS has to figure that out is to go to the taxpayer and ask them to produce information, which is messy for the taxpayer. So with that, Nelson, I'll turn it back to you.
Yeah, so the John Doe summonses headline grabbing and probably instill a bit of fear. But as a process, is sort of laborious, as Phil has mentioned, and messy for the IRS, for the exchanges, and also probably for the taxpayers themselves. Ashlyn, do you have a question for us?
Yeah, no, so as I was thinking about this, I mean, it sounds like you're saying messy and onerous on all fronts. And, creating new guidance is obviously onerous. But it seems like that would almost be a quicker path. Is that not the case? Why are we seeing sort of this impending guidance that hasn't dropped yet, and then this action that seems sort of, preemptive and expending resources in a way that perhaps doesn't seem as clear cut? Is there precedent for this kind of thing?
Well, I think in the past. Go ahead.
Sorry. No, go ahead.
Well, I think in the past, I think it's sort of which is ready first, right? I think from my perspective, the proceeding with the John Doe summonses has a sort of an effect on the public, in a sense, the same way that providing the crypto tax FAQs in 2019, or putting a tax question on a 1040, say, have you entered into any crypto transactions? It has an effect on the public messaging that the IRS is serious about enforcement. And they can do that even ahead of finalizing tax regulations, which in this case, in the case of crypto, as we'll get into a little bit later, might be a bit complicated. So it takes time to work through the process. And I think due to the last couple of years, with the pandemic, with all the relief provisions and all the things that the IRS had to handle on top of finishing up changes based on the Tax Cuts and Jobs Act that was put into place several years ago, I think that the work probably got delayed on the regulatory front. But I think that part of it is coming. Phil, did you want to add to that or correct me?
No, I would just add, Nelson, that I agree with everything you said. Right now, before regulations are issued, it's the only way for the IRS to do enforcement or the first step of enforcement. There's no doubt in, I think, anybody's mind that, and we'll talk about this in a bit, that getting 1099 reporting would be a far more efficient process. And so that's the ultimate goal, but before that goal is reached, the IRS didn't want to leave the taxpaying public with the impression that, everything's okay. You can get away without reporting your crypto transactions. And as Nelson said, the John Doe summonses tend to get a lot of publicity as a way of sort of notifying the public that the IRS is serious about the issue.
Absolutely. The messaging is very important. I wrote at least like 4 stories on different John Doe summons. That being said, though, how often does that really translate into enforcement? Is this information and this sort of laborious process, is that going to do something to really bring certain perhaps underreporting to justice, or is this more of a messaging thing?
I think it's a bit.
Sure.
Go ahead.
And actually, Nelson, do you want to talk about the Swiss bank enforcement effort? Maybe that's a good example to talk about in this case.
Yeah, I was going to talk about two things. One was, as you mentioned, a number of years ago. This was when Phil and I were still younger. There was I guess the issue with the IRS was tax avoidance by U.S. taxpayers by putting their assets in non-U.S. bank accounts, like Swiss bank accounts and so forth. And the way the IRS first challenged that was with the John Doe summons with one of the financial institutions as a way to get information on those particular taxpayers, but also as sort of the first volley of what later became a whole new regulatory regime where we call it FATCA now, and where financial institutions outside the US are now obligated to report on US accounts that are opened overseas. So I think it's a little bit of both, right? It is messaging, but if you look at the UBS case from the offshore account scenario, they actually ended up prosecuting a number of taxpayers after that with the information they gathered. And I think it's similar to the Coinbase John Doe summons back a couple of years ago, several years ago now, where they got that information. There is a time lag, but they started investigating some of those taxpayers that with the information they got from Coinbase, from the Coinbase summons, including, I think over the last couple of years, they sent these so-called information letters out to taxpayers who they thought had crypto transactions, and that I think in part is from the Coinbase John Doe summons.
Great, that really puts it in context.
Anything to add on your side, Phil?
Nelson, maybe just quickly cover slide 8 so people have an idea of the kind of information the IRS is getting in addition to names and IP addresses and things like that.
Yeah, I mean, they're trying to identify specific transactions that can give rise to taxable income. So the days when you purchase cryptocurrency, the dates when you sold cryptocurrency, and the dollar value of your accounts, so to get a sense of which ones are worth pursuing. But mostly they end time, right? They end time and of transactions and the records of perhaps inflows and outflows from the particular accounts.
And then, as I said, that gives the IRS a lot of information, but not a tax liability number. So at the end of the day, it's up to the taxpayer to reconcile all that information, which again is not a very efficient process either for the IRS or the taxpayer or the crypto exchange. But right now, that's what we got. And the solution to this inefficiency is 1099 reporting, which we will get to. Nelson, I'll turn it back to you, or Ashlyn, if you have any other questions.
Nope, those are the only that come to mind right now.
Okay, so Phil, we're going to advance to slide 11, just to now talk a little bit about tax information reporting rules. Some of you, I know, might not know about what tax information reporting, when we mention tax information reporting, what it is. And it's basically, for example, if you open an account at a bank, like it's probably the simplest case, and you earn interest income over the course of the year, under tax information reporting rules, the bank is required at the end of the year, usually in January, to file a 1099 form. They send it to you so you know how much interest you earn in the account. In these days, probably not much, but they also send the same return to the IRS. And so what the tax information reporting framework does is it first notifies the IRS that you've earned income. It notifies you that you earned income and that the IRS has the same information. And third of all, it gives you the information that you might need to put on your tax return. So from a tax compliance standpoint, tax information reporting is believed to increase compliance from somewhere around 30% if there was no tax reporting to somewhere in the 90% range. So it's that much of a difference between having tax information reporting, a 1099 form, and not. And what happens in this particular framework is that in order to report a 1099 to you and the IRS and allow the IRS to match that income to you, you need to provide the bank with a taxpayer identification number. And in most cases, this would be a social security number. And the rule says that if you don't provide a taxpayer identification number, the bank is then required to withhold on interest payments to you in that case. So the withholding rate, which we call the backup withholding rate, is 24% at this time. So if you don't provide a tax ID number, the IRS still gets its money because it's going to the bank is going to withhold 24% of any interest payment to you and deposit it to the IRS on your behalf. And the same thing happens in the brokerage side with sales proceeds, which is worse because they'll withhold 24% of your actual total sales proceeds. So it becomes somewhat draconian. Taxpayers then just go ahead and provide the taxpayer identification number. Phil, do you want to add anything to sort of the general overview of 1099 reporting? We might have lost Phil for a little bit. Ashlyn, can you still hear me?
Yep, all good on my end.
Okay. So I will proceed until I hear Phil on the line again. And I think what we wanted to talk about was that the IRS currently has had tax information regulations for crypto on what is called its priority guidance plan for the last couple of years, and is expected soon to issue regulations in this particular area. The particular guidance that we expect would be under what they call Section 6045, which is the same provision that governs reporting for securities by brokers. So we expect that there will be some guidance relating to Form 1099B that you would receive from a broker, perhaps with modifications as to who is required to report and what they're required to report. The expectation is that the regulations will come out in proposed form, where taxpayers and industry participants will have a chance to comment on them before they are finalized. But the timing of them is still somewhat uncertain. Last we heard from the IRS, they say in the near future, but the near future is probably a somewhat amorphous term. Phil, are you back? Do you want to add something to that?
Yeah, I'm sorry, I was on mute. I'll just add, Nelson, that in the Coinbase summons, Coinbase, up until last year, I believe, actually followed or tried to satisfy the IRS by producing what are called Form 1099-Ks. And it reported transactions in which there were at least 200 transactions and $20,000 in payments. This is covered in slide 12. if any of you actually received a 1099-K, you note that it wasn't really helpful to you because it just reports gross amounts from every transaction. So, for example, you could have had $100,000 of transactions and an overall loss in terms of your tax liability. So there's really no money in it for the IRS. And from that perspective, that kind of information is not really helpful to the IRS either. 1099-B reporting is transaction specific. So the IRS knows at the very least the gross amounts from every specific transaction, but it can also provide more information, for instance, the basis or your cost for each crypto unit, so that the IRS and the taxpayer can figure out gains. But that gets us into whether the IRS regulations will require cost basis reporting and what cost basis reporting is. And with that, Nelson, I'll turn it back to you.
Well, thank you for that, Phil. That is sort of the state where we are right now. For a while, there were some exchanges providing 1099-Ks, as Phil mentioned. Over the last year, I think we saw on the Coinbase website that they were no longer providing the 1099-Ks for the trades, probably as Phil mentioned, because it seemed more confusing than not for customers. And then there were a few exchanges that did 1099-Bs or crypto brokers that did 1099-Bs, but not many. And so it's still in a state of uncertainty as to what the proper reporting should be, pending the regulatory guidance that the IRS is supposed to issue in the near future.
I'm just wondering, how does the 1099 miscellaneous also fit into this conversation? Because as a couple exchanges moved away from Ks, they still held that they filed miscellaneous when necessary. So how does that fit into the conversation of K, B, any other form?
Yeah, that's a good question. So there's a lot of 1099 forms, each specific to a different sort of income type. And the 1099 MISC is sort of the other. It's everything that's not sort of specified in the other forms. So sort of other income. And what might be reported on a 1099 miscellaneous would be something such as rewards that you get, like a lot of these incentive rewards that some of the exchanges give. For example, if you learn about particular cryptocurrency, they might give you $3 or $2 of cryptocurrency, and that might be reported on a miscellaneous. The other thing that's coming up is staking rewards, right? So if you have a coin that is proof of stake and can be staked, and you earn rewards from that via the broker or exchange, then they might be providing a 1099 MISC saying that you had miscellaneous income, which is a staking income. There's also a case where I think is not as well thought through, but the IRS have been talking about hard forks, right, of cryptocurrencies as taxable events. So when you have, for example, a particular cryptocurrency going through a hard fork and an account holder receiving a new cryptocurrency, that new cryptocurrency, according to the IRS, is taxable, is a taxable amount based on the fair market value on the date that you receive it. So question, how should that particular hard fork be reported? One possibility is that new currency might be reported on a 1099 MISC as other income, so that you have a record that was given to you, and therefore now you have a new cost basis in that amount.
Yeah, actually, and I'll add that one problem with 1099 miscellaneous reporting is that it applies to income items as Nelson referred to. So, for example, income from staking rewards, for example, or income from airdrops of new cryptocurrencies. What it doesn't apply to, at least by its terms, is gain from transactions. So, for example, if I exchange my Bitcoin for cash, technically 1099 miscellaneous reporting doesn't apply. If I exchange Bitcoin for Litecoin, technically 1099 miscellaneous reporting doesn't apply. That's why the miscellaneous form is not really being pursued, and probably it's also a yearly form that reports a gross income amount, which again is not necessarily that helpful to taxpayers or the IRS. So that's why the IRS is going to pursue issuing regulations under 1099-B, and we can get into a little more detail about that. Nelson, maybe you want to talk a little bit about how 1099-B reporting works currently for securities?
Yep, I can do that. And I also see a couple of questions from the audience. One we could just probably quickly answer. What is the liability to the exchange if W-9 is not provided? So assuming that you have a reportable payment, and people still argue about which crypto transactions are reportable, usually the liability for an exchange or withholding agent comes in two parts, right? One is if you don't have the W-9 and a TIN, you might be required to back up withhold. If you don't back up withhold on the payment, then you will be, as a withholding agent, you'll be liable for that under withholding that you will otherwise be required to withhold. That's probably the principal liability. The other part would be penalties regarding non-filing of the tax returns, 1099. So there's two potential areas of liability. The better, I think, the more practical answer in case where the law is not entirely clear is to begin documenting account holders probably with a W-9, because at least you can avoid, if you have the W-9 and the TIN, so backup withholding generally doesn't apply, and therefore you at least avoid that part of the liability exposure. I don't know, Phil, whether you had anything to add on that question.
No, I would just emphasize the point, 2 points, I guess. One is because the current state of the reporting, 1099 reporting requirements is so unclear, it's unlikely that exchanges are going to face penalties currently. That will change once regulations are issued, obviously. The other point, just to emphasize what Nelson said, is usually the biggest liability an exchange would face would be the liability for failure to back up withhold. And that penalty applies when you don't have a taxpayer identification number at all, or the taxpayer identification number you have is incorrect and the IRS told you it was incorrect and you failed to get the correct number. So one thing that exchanges can do, and personally I think it's never too early to start that, is obtaining taxpayer identification numbers. Right now, all of the exchanges, I believe, at least in the U.S., comply with anti-money laundering rules, but those rules don't necessarily require a taxpayer identification number. And so, you know, a number of exchanges I know will now, as part of the sign-up process, require a taxpayer identification number, a social security number for an individual, but that's not uniform across the industry.
Thanks, Bill. I think we just advanced now to slide 14, which compares. Oh, I think I clicked it. Sorry. Which compares sort of tax reporting on securities and some of the differences that might occur when you deal with digital assets. For tax reporting that brokers currently do on securities now, there's been a set of rules, what we call the cost basis regulations, that's been phased in over the last 10 years, where brokers are now required to not only report the sales proceeds when you sell a particular, what they call covered security, but also monitor the cost basis. And cost basis is usually your initial acquisition cost, but it can change. It can change because of wash sale rules. It can change for debt instruments because of a number of rules that affect the amortization of premium, OID, and all that sort of things. So the cost basis is supposed to be maintained by the broker, and when you sell, the broker is supposed to report both the sales proceeds, but also what your tax cost is, so that you can determine whether it is as a gain or loss, and then also whether it's a long-term gain or a long-term loss, or a short-term gain or a short-term loss. So a lot of those rules actually create some similarities and probably helpful similarities for reporting crypto transactions, in the sense that in both cases you have property that is potentially subject to capital gains tax, or maybe a capital gains loss, depending on the transaction. You have a property. The IRS has also noted that for crypto assets, you can use the FIFO method for determining which lots are being sold if you have multiple lots. So FIFO is first in, first out. So the ones you purchase first would default to be the ones that you sold if you cannot otherwise specifically identify which of the units of crypto that you have sold. And in many cases, at least for retail customers, is the sale of crypto and the purchase of crypto can be done through large exchanges or brokers. And I guess you can transfer these crypto assets from one broker to another broker. But also, when you think about the digital assets, there are some things that are just fundamentally different, and which would make reporting on them something that needs to be sort of specifically tailored to these particular assets. For example, one of the principal issues with maintaining the tax cost of crypto assets is that they can be transferred to private wallets. You don't see that happen for securities. Securities might be transferred from one account at one broker to another account at another broker. But for crypto assets, that's even often an encouragement in the community to say, oh, send your crypto to your own private wallet, it's safer there. And so there's a lot of transfers from exchanges to private wallets and from private wallets back to exchanges. And one of the critical issues is, how do you maintain, how do institutions maintain the cost basis when you have these type of private transfers? In the securities area, when you transfer securities from one broker to another broker, there are specific rules where the sending broker is supposed to provide the tax cost information to the receiving broker, so the receiving broker maintains that record. You can do that at an institutional level. It becomes much more of a challenge when you deal with private individuals transferring crypto assets back and forth between exchanges and private wallets. Phil, do you want to say something about that?
No, it'll just be interesting to see how the IRS deals with the problem of transfers of cryptocurrencies. My prediction would be that if you go transfer directly from one exchange to another, let's say Coinbase to Kraken, they will do what they currently do with securities, which is require Coinbase to provide the cost basis information to Kraken. That doesn't work, as Nelson pointed out. If I transfer my Coinbase Bitcoin, for example, to my private wallet, it's not a Coinbase hosted wallet. And then when I get ready to do exchange that Bitcoin, I transfer it to Kraken. In that case, Kraken doesn't have the basis information. And it'll be interesting to see how the IRS deals with that issue. It's not ideal from an information reporting perspective to have the taxpayer provide that information, because the taxpayer may be, motivated to provide a higher basis than is accurate, for example. The IRS may deal with that problem, though, by, cross-checking basis numbers with tax returns, or, just requiring, which they do now, that you report the basis on a tax return and then require that that's the basis the individual taxpayer must report to the exchange. But it'll be interesting to see how they deal with that.
Yeah.
I think another problem is decentralized exchanges. These are basically marketplaces that aren't sponsored by a corporation, for example. It's just basically a computer platform. Right now, a lot of these decentralized exchanges provide market value information, but it's also possible to just directly trade a cryptocurrency in a peer-to-peer way, and so you don't really have a financial institution in the middle. What you have is a computer program that two parties are using, and it'll be interesting to see how the IRS approaches that issue. I'll turn it back to you, Nelson.
Thank you, Phil. Yeah, decentralized exchanges is definitely a structural problem, right? The 1099 framework relies on financial intermediaries to report, and if you don't have an intermediary, that makes it fundamentally challenging. I was going to go on to our last topic, which is customer and the IRS, since we have about 10 minutes left to our time. I don't know.
Just before we go there, I see a couple questions in the chat, basically asking how certain rules that exist already for securities apply to crypto. I'm seeing somebody ask about the wash sale rule. I'm seeing somebody also ask about 1031 exchange. What do we know right now, if you want to answer those specific questions, or also what do we know right now about how securities rules apply to crypto? Because we're waiting for this guidance. So what do we know that does apply right now?
Well,
I'll take a first stab
okay.
at it. Basically, the securities rules as they exist now don't apply to cryptocurrency, with the possible exception of tokens that actually represent an equity interest in an entity or a debt interest in an entity. But when we're talking about cryptocurrency, Bitcoin, Litecoin, Dogecoin, they don't necessarily apply now. I won't get into detail about where they possibly could apply, but I think that the general answer is that they don't apply right now. The wash sale rules apply to securities, stock and debt, for example. So they technically don't apply now to cryptocurrencies. The Section 1031 like-kind exchange rules were changed in 2017, I think, or maybe later.
Yeah,
I
effective
think it was 2017. Yeah, to only apply to real estate, so they don't apply to cryptocurrency anymore. Nothing, anything to add?
No, exactly my view as well. I mean, 1031 might be a pre-2018 issue, but not afterwards. To the more general question that Ashlyn had asked about which rules apply from the securities area to the crypto assets. There are a number of tax rules that are specific to particular products, financial products, and in particular, some are applicable only to securities. So if the digital assets is not treated as a security, then they might not apply. I mean, as Phil mentioned, hypothetically, there could be some digital assets that basically could be treated as securities because they represent interest in the underlying company and so forth, and you get profits interest based on that. And maybe that will crop up more and more as we head into some of these dividend paying tokens and so forth. But perhaps for the main cryptocurrencies, I think the general view is that they are not treated as securities at this point, and some of them, and many of those securities specific tax rules will not apply. So I think where we wanted to end up is just talk a little bit about the customer's need for tax data, as well as the IRS need for tax data. And I guess at that question that we had about whether you can satisfy both the IRS and the customer is probably a false one. You probably have to satisfy both if you were to stay in business and be in compliance with the law. And to some extent, I guess it seems like the data that the IRS is looking for might also be the data that the customer is looking for, especially now when the IRS has made a lot of noise about the need for taxpayers to comply with filing tax returns on their crypto trades. The challenge is where do I, let's say I was a trader, get my information? It's not always easy with the number of decimal places that you have for cryptocurrency, as well as the probably numerous trades that might happen in different amounts, to maintain a record of the trades, as well as your cost basis and so forth. And there appears to be some demand from customers to have the exchanges or the institutions that help them trade cryptocurrencies to provide that sort of tax data. At the same time, it's the same sort of data that the IRS may be looking for as regulations are issued in the near future. I don't know, either Phil or Cam, do you have some thoughts on this, on the nature of these particular relationships, customers and the IRS?
Nelson, it's actually an interesting topic because I think we're going to end on that in a minute. But I think you're right. The information, setting aside what people think about taxes in general and paying taxes, the information needed to do that is very similar for both the IRS and investors. And so if we have time when we get to the slides about how to think about implementing solutions, I think it's a mistake not to think about client satisfaction, because that's the opportunity here. We won't have a choice whether or not, as institutions, whether or not to report to the IRS, but we can use that same information to make life easier and the client experience far superior for our clients.
Now, I think that's an important point, Cam. And I think thinking about client experience as well as sort of what the system's needs are in terms of to provide both that experience and to provide IRS with the right information when those regulations come out, I think will be key. Where is that intersection, right, between the ability to comply with the rules that the IRS will issue, and how do you provide that in a format that is accessible to the customers? I mean, in the securities world, we're familiar with companies providing 1099B information that you can basically download into your tax software, and wouldn't that be something nice for crypto account customers as well, right? It is something that they might expect if they also trade securities, but it's not currently in that format. And partly, it could be that when the IRS issues regulations, it might actually enhance that ability because everything will be more standardized.
Yeah, this actually feels very similar to the securities industry back in the early 2000s when there was talk of cost-basis reporting coming, and everyone knew it was coming, just like we expect that guidance for crypto is coming. And some firms got ahead of the requirement to roll out cost-basis systems for their clients because it was actually a barrier to trading activity for, particularly for active traders. All the confusion around or lack of transparency around tax liabilities and sort of that March surprise that happened when they sat down with their CPA, that was actually resulting in a barrier to trading with brokers. And I think the same applies to crypto. A lot of investors in crypto don't have a lot of experience in investment tax, and you hear a lot of stories about surprises in March when they sit down to do their taxes. And even something as basic as lot relief method. Nelson, you mentioned earlier FIFO. Up until recently, crypto only went up, and overall the trend is still going up. So FIFO is actually a terrible relief method for an investor unless you like to pay taxes. And specific specific identification of lots is far superior. But the fact is, most crypto investors aren't even aware of that.
Yeah. Phil, do you want to add to this particular topic? I know you had some insight on technology and is sort of like the systems that you need to address these issues is probably a marriage between technology and tax expertise.
Yeah, I'll just add quickly, since we only have a minute left, that information reporting, as Nelson just mentioned, requires basically two sets of people to implement. One is you need to have the technical know-how about how IT systems work and what kind of information they produce. And, a lot of companies in the crypto space certainly have the IT technical know-how to do it. The danger is they don't have the tax knowledge to necessarily do it correctly. So when you're considering, development, you need to think about having somebody who's knowledgeable about taxes being involved. The other point I would make is crypto exchanges traditionally haven't had to do information reporting, so they don't, unlike the securities industry, they don't have an information reporting system that they can adapt to crypto. They have to start from zero. So that's another important consideration.
Thanks, Phil. Ashton, do you want to, do you have a final question or closing thoughts?
Yeah, I guess I'll say it looks like we've done pretty good in answering some of the questions in the chat. Is there anything else that you think is important that we touch on? I feel like we got through a lot.
Just one thing I want to mention is that I think the IRS is looking both at, when you think of the information that came through the Kraken John Doe summonses, as well as some of the proposals from the Biden administration going forward, the IRS is not looking solely at information from one exchange, but also they're trying to look at information from various exchanges, including offshore. And I think that would be the push going ahead, that they will try to coordinate something like FATCA, where they're looking to have reporting from offshore exchanges to the US, and also because of the need to give something back to those other countries, they'll also try to get information, get US institutions to obtain information about non-US beneficial owners in crypto exchanges, so that they will have that information to exchange with other countries. So that's also something that's coming up.
Absolutely. Yeah, and my understanding is that's often how it's gone before, correct? Where the US will sort of set tax policy and that will sort of expand internationally over time.
Yeah, I think that's happened, especially in this information, tax information reporting space, where people like to piggyback on the IRS because the US has some pull in terms of its financial markets and what it can do.
Absolutely. Well, great. Does anybody else have something they'd like to add? Otherwise, I feel like we've really covered a lot today. No? All right. Well, thank you for being here, everybody. I really appreciate it. I've learned a lot. I hope you did too. And I look forward to connecting with anybody who's interested in continuing the conversation going forward.
Thanks, Aislinn.
Great.
Thanks, everyone.
All right. Have a great